Hi, it's the Tax Geek again with more of your taxes oversimplified. This video is the first of a series of videos called IRA 101 and focuses on what IRAs are and the rules for contributing to them. First, what is an IRA? It can easily be summarized in those three letters. The I is for individual. IRAs are set up for one person and one person only. They cannot be jointly owned. Married persons can have IRAs, but each spouse must have his or her own IRA. The R is for retirement. IRAs are primarily retirement investment plans. There are often significant penalties for withdrawing money from an IRA before reaching age 59 and a half. And lastly, the A stands for arrangement. IRAs don't necessarily have to be just one account. They can be collections of different investment accounts that can be gathered into one or more arrangements. IRAs come in two flavors, traditional and Roth. A deeper dive into Roth versus traditional retirement plans can be found by clicking the video card above or the link in the description. But simply, with a traditional IRA, you reduce your taxable income when you contribute to it and pay taxes on the distributions when you make them. But contributions to a Roth IRA don't reduce your taxable income when you make them, but distributions from them upon retirement are tax-free. As of 2020, the maximum you can contribute in any year to an IRA is $6,000. Or $7,000 if you are age 50 or over. However, to contribute to an IRA, you must have compensation in the form of wage or self-employment income of at least that much. For example, if Sam, age 45, received $5,000 from a part-time job but received $20,000 in investment income, his IRA deduction would be limited to $5,000. If you are married and one spouse has no eligible compensation, the spouse with no compensation may contribute to an IRA if the working spouse has sufficient compensation equal to or greater than both spouses' contributions. Meet Charles and Caroline. Charles has wage income of $75,000 and Caroline is a homemaker. Each may contribute the maximum amounts to their IRAs because Charles has sufficient compensation for both contributions. But remember, since the I in IRA stands for individual, both Charles and Caroline have separate IRAs and can have different contribution limits if one is over 50 and one isn't. The contribution limit of $6,000 or $7,000 is the total contribution for all the IRAs you have. So if you have a traditional and a Roth IRA, you can't contribute $6,000 or $7,000 to both. Let's take a look at contributions to a traditional IRA first. If neither you nor your spouse participates in a retirement plan, you may take the full amount of your contributions as an adjustment to income on line 19 of Part 2 of Schedule 1. You are a participant in a retirement plan if the retirement plan box is checked on your W-2. You don't have to contribute to your company's retirement plan in order to participate in it. Just being eligible to participate in it is enough. If you do participate in your employer's retirement plan, your reduction may be limited. Here is a chart showing how the deductibility of an IRA phases out by modified adjusted gross income for different filing statuses. If you are married and you don't participate in a retirement plan, but your spouse does, your IRA deduction is still limited, but the phase-out ranges are different. But remember, even if you can't deduct all your IRA contribution, you can still make a contribution up to the $6,000 or $7,000 limit. You just can't deduct it. This establishes a basis in the IRA that will have to be accounted for when the money is withdrawn. Roth IRAs have different contribution limits. Roth IRA contributions are also limited by adjusted gross income. These limits apply whether you participate in your employer's retirement plan or not. Here are the phase-out ranges by filing status. And again, even if you are limited in making a Roth IRA contribution, you can still make a traditional IRA contribution up to the $6,000 or $7,000 limit. This deduction may or may not be deductible based on the circumstances. If you make a non-deductible traditional IRA contribution, you must file Form 8606 to tell the IRS about the contribution, so that they have a record of the basis when you exclude it from your income many years down the road. A traditional IRA is one of the few ways you can affect your taxable income after the tax year is ended. As long as you make a contribution by the due date of the return, usually April 15th, but you never know these days, you can take an IRA adjustment on that year's tax return. So, for example, if Bert and Sally, who are in the 22% tax bracket, find that when they do their 2021 taxes, they have a $1,500 balance due, they can make two $6,000 contributions to their IRAs before April 15th, 2022, and turn their $1,500 balance due into a $1,140 refund, all while contributing to their financial security later in life. And when was the last time you got an instant $2,640 return on a $12,000 investment? So that's the lowdown on what an IRA is and the rules for contributing to one. As always, there are additional resources and information in the description below. And if you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. If you have any questions, comments, or suggestions for future videos, please leave them in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.